Welcome back to another deep dive into the stock market, where we separate the silicon from the snake oil. Today we're analyzing Texas Instruments, ticker TXN, a company that's been making chips longer than most of us have been alive, yet somehow missed the memo about the AI revolution. While everyone's going crazy over NVIDIA and AI stocks, TI is over here like, we make analog chips for washing machines and car door handles. And we're proud of it. But here's the thing. Sometimes the tortoise beats the hare, and sometimes boring beats flashy. So grab your calculators, and let's crunch some numbers on this $159 billion semiconductor giant that's trading like it's having an identity crisis. The company and its promoters. Who runs this chip shop? Texas Instruments wasn't born yesterday. It's been kicking around since 1951, founded by four guys with names that sound like they belonged in a 1950s engineering textbook. Cecil Green, Eric Johnson, Eugene McDermott, and Patrick Haggerty. These weren't your typical Silicon Valley hoodie-wearing entrepreneurs. They started as a geophysical services company helping oil companies find black gold in Texas dirt. Fast forward to today, and the company is led by CEO Haviv Elon, who took the reins in April 2023. Elon's been with TI for over 20 years, working his way up through the ranks like a true corporate climber. At 56, he's making $19 million a year. Not bad for a guy whose company makes chips that go into, well, almost everything except the latest ChatGPT servers. The company transformed from oil exploration to becoming a semiconductor powerhouse, pioneering the transistor revolution in the 1950s and giving us the first portable transistor radio in 1954. Fun fact: they also gave us the pocket calculator, which probably saved more students from math homework disasters than any other invention in history. 10-year financial analysis. The numbers don't lie, but they do disappoint. Now let's talk numbers, because this is where things get interesting. And by interesting, I mean, your portfolio manager might need a stiff drink. Interesting. Revenue reality check. Over the past 10 years, TI's revenue has actually declined at a compound annual growth rate of 2.0%. Yes, you read that right, negative growth. They peaked at $20 billion in 2022 and have since dropped to $15.6 billion in 2024. It's like watching a really slow-motion roller coaster that only goes downhill. Profitability picture. Net income CAGR, 5.1%, EPS CAGR, 6.6%, current net margin, 30.7%, gross margin, 58.1%. The bright spots. Despite the declining revenue, TI still prints money like a Federal Reserve branch office. Their 30.7% net margin is the envy of many companies. They're basically the equivalent of a really efficient lemonade stand, selling less lemonade each year, but making sure every cup is pure profit. Balance sheet strength. Here's where TI actually shines brighter than a freshly manufactured silicon wafer. Total debt, $13.6 billion. Cash, $3.2 billion. Debt to equity ratio, 0.80, manageable. Current ratio, 4.1. Stock chart technical analysis. Reading the tea leaves looking at TI's stock chart is like watching a soap opera. Lots of drama, some good times, some bad times, and you're never quite sure what's going to happen next. Current technical picture. Trading at $175.11 as of October 14, 2025, 52-week range. $139.95, $221.69, down 13.5% over the past year, trading below both 50-day, $187.72, and 200-day, $186.56. Moving averages. Technical indicators are screaming. RSI, 3.98, in oversold territory. The stock is having a sale. MACD, 3.18, bearish signal. The trend is not your friend. Key support, around $170, 172. We're dancing dangerously close. Key resistance, $190, 200. The ceiling TI keeps bumping its head on. The technical picture looks like someone threw a semiconductor wafer against the wall. It's cracked, it's fallen, and it's not sure which way is up. Graham Valuation. The value investing reality check. Now for the moment of truth. What would the father of value investing, Benjamin Graham, say about TI's current price? Spoiler alert. He'd probably run faster than a cat from a cucumber. Graham number calculation. Using Graham's famous formula we get current EPS, $5.20, book value per share, $9.54, Graham number, $33.40, current price, $175.11. The verdict, TI is trading at 424% above its Graham number. That's not just overvalued, that's, I bought a house in 2007, overvalued. Graham's criteria check. P/E ratio, 3.7, Graham wanted less than 15, P/B ratio, 18.4, Graham wanted less than 1.5, P/E times P/B, 618.4, Graham wanted less than 22.5. Score, 0 out of 3. Graham would be spinning in his grave faster than a hard drive from the 1990s. Pros versus cons. The bull and bear wrestling matched the bull case. Why TI might not be dead yet. The domestic manufacturing hero. With 70–80% of TI's manufacturing in the United States, they're positioned like a chess master for the ongoing US-China trade tensions. While other companies are scrambling to reshore their operations, TI is sitting pretty saying, "We never left, y'all." Recession-resistant revenue streams. TI's chips go into industrial equipment and cars, stuff that needs to work whether the economy is booming or busting. Your washing machine doesn't care about inflation, it still needs TI's chips to spin your clothes dry. The dividend aristocrat in training. TI has been increasing dividends consistently and currently yields 3.17%. In a world of meme stocks and crypto volatility, a steady dividend is like finding a calm coffee shop in Times Square. Cash generation machine. Despite revenue declines, TI still generates cash flow like a Vegas slot machine that actually pays out. Their balance sheet is stronger than a Texas oil rig. The bear case, why TI might be yesterday's news. The AI party they weren't invited to. While NVIDIA is making billions from AI chips, TI is making chips for garage door openers. It's like being the world's best typewriter company in 1995. That pesky revenue decline. You can't grow a tree without water, and you can't grow a stock without revenue growth. TI's 2.0% revenue CAGR is about as exciting as watching paint dry on a semiconductor fab. Valuation nosebleed territory. At 33.7 times earnings, TI is priced like it's the next Tesla, but it's growing like it's the last blockbuster. The premium valuation makes about as much sense as buying ice cream in Antarctica. Cyclical industry blues. The semiconductor industry is more cyclical than a washing machine, and TI is currently in the everybody's cleaning out their inventory phase. Important checks. Skeletons in the silicon closet scandal department. TI has been surprisingly clean compared to some tech giants. The most notable legal issues have been typical patent disputes and employment-related lawsuits, nothing that would make shareholders lose sleep. They've paid about $495,000 in penalties since 2000, which for a $159 billion company is like finding a penny on the sidewalk. Global market position. TI ranks number 14 among global semiconductor companies by market cap. They're not the biggest fish in the pond, but they're not plankton either. They hold a dominant 51% share in the interface market, which is like being the king of a very specific castle. However, they're facing headwinds from China's anti-dumping investigation on US analog chips, because apparently trade wars affect more than just soybeans and steel. Conclusion. The final verdict. So, what's the bottom line on Texas Instruments? It's like that reliable friend who always shows up on time, pays their share of the dinner bill, but never gets invited to the cool parties. The good. Strong balance sheet, consistent dividend, domestic manufacturing advantage, and recession-resistant end markets. The bad. Declining revenue growth, missing the AI boom, premium valuation that doesn't match the growth profile, and technical indicators that look like a ski slope heading downhill. The ugly. Trading at 424% above Graham's fair value calculation, which is about as appealing as a root canal performed by a blindfolded dentist. Investment perspective. TI appears to be caught in no man's land, too expensive for value investors, too boring for growth investors, and too cyclical for income investors. It's like a stock designed by committee to please no one in particular. For those brave enough to consider TI, you might want to wait for a better entry point. With support around $170,172, there could be better buying opportunities ahead. Or you could wait for the company to prove it can grow revenue again. Revolutionary concept, I know. What this means for you, given your background in creating detailed stock analyses with financial metrics and Buffett-style valuation approaches, Texas Instruments presents an interesting case study in how premium valuations can persist even when fundamental growth metrics are declining. The company's strong balance sheet and defensive market position might appeal to conservative investors, but the current valuation appears disconnected from the underlying business performance, making it a cautionary tale about paying too much for quality in a low-growth environment. Standard financial disclaimer. This analysis is for educational and entertainment purposes only and should not be considered as personalized investment advice. All investments carry risk, including the potential loss of principal. Past performance doesn't guarantee future results. The author may or may not hold positions in the securities discussed. Always conduct your own research and consider consulting with a qualified financial advisor before making investment decisions. Remember, the stock market can remain irrational longer than you can remain solvent, and sometimes the chips don't fall where you expect them to, even when you're analyzing a chip company. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel, and let us know in the comments which company you'd like us to analyze next.